through some of the highlights of trade as we kick this week off, looking, of course, specifically at yesterday's trading activity and how we've started this morning's trade off as well.
Probably actually the highlights that we witnessed yesterday was that there was quite heavy selling in Equity Bank, but this time it was mostly by domestic retail investors against basically what happened last week when you saw quite a lot of significant amount of foreign investors coming in with regard to Equity Bank. Kenyan actually yesterday actually experienced some gains, irrespective of the earnings losses that it experienced. Probably actually what you're saying is that investors could have discounted the loss as a one-off item and are quite pessimistic about its future outlook.
The debt market is also attracting quite a bit of interest over in Kenya, with investors still contemplating the effect of this new 365 T-bill. What impact do you expect this to have on the equity markets as we move forward?
The interest in the bond market isn't actually very new. It began towards the fourth quarter of last year. Mostly what you've seen is that domestic fund managers are the ones who actually have been weighting most of their assets in favor of bond assets. They haven't been very bullish on stocks, and mostly that's because of what's been happening in the economic front. Plus, they also expect actually to make most of their gains going forward from trading in government bond paper.
Well, Stefan, while that bit of a shift does occur, it isn't just the Nigerian banking sector, that's been in the spotlight of late. Most of the major company news out in Kenya has surrounded the banks over in the country, releasing first half numbers. What have you made of the reporting season thus far?
I mean, of the 5 banks that we've looked at in the past couple of weeks that have reported, you see NPLs moving up, from a range between 14% and 46%. You're seeing coverage ratios improving for some of the banks, in others dropping. So I think it's just a factor of the current market cycle, and obviously as the economy is taking a bit of a turn south, with agriculture not doing that well, you're obviously seeing a lot of the non-performing loans improve. Going up. Well,
in your mind, I mean, every investor would be saying it is a sign of the times. I mean, if we have to look at Equity Bank specifically, the numbers have been digested by the market already, and we saw the company post a 15% decline in net profits here. What did you make of these numbers, where in the past this has been the star performer in the banking arena, recording triple-digit growth?
Yeah, I mean, if you look at it year on year, half on half, there's a big factor last year in the first half, which was the Safaricom IPO and the fact that they were one of the receiving houses in the local market. So you had loan growth for the first half of 2009 up 48%, but then you have commission income fees which were marginally up, and obviously that is because it's a factor of the Safaricom IPO. So obviously you're looking at a base which is different from a year-to-year perspective. You're also seeing non-performing loans, as I said, which went up 48%, but it's also a function of the fact that they microbank mainly, and obviously non-performing loans move differently in that market.
Let's unpack that with Roy. I mean, Roy, while operating expenses increased 32%, partly due to the aggressive expansion strategy Equity Bank has embarked on, the concern really comes with the fact that Equity Bank has doubled its provisioning for bad debts, eating into profits. How concerned are you of the level of provisioning they've made, and is the market concerned about this level as well?
Yeah, there is a bit of concern with regard to the increase in provision for loans. Looking at the backdrop from where it came from, beginning last year in June, when they actually were quite aggressive, they made quite aggressive with respect to lending to the retail sector. The double increase from 0.7 billion to 1.6 billion. I think it was quite prudent, in my opinion, that they did it at this time. Going ahead, I see some slowdown in their growth, because looking at liquidity from a high of 56% in June last year to about 32% this year, and comparing it actually to the backdrop that the Central Bank of Kenya actually requires all banks to maintain a liquidity ratio of about 20%, they may have to slow down growth, and mostly the growth slowdown will be towards the retail sector. But we still see some lending, most lending by banks towards the public sector and towards corporates.
What's your view on the bank's risk mitigating strategies to cushion itself, from the potential losses from non-performing loans moving forward, especially because bulk of their concentration is on the unbanked and lower market segment?
I think this time they're going to be more selective, although actually what they've stated is that they will still continue banking for small enterprises and the retail sector. But I think going ahead, they'll be more selective in the new loans that they advance.
Well, Stepan, as you highlighted earlier, I mean, the drop in profits had been attributed as well to that once-off from the Safaricom IPO it earned in the first half of last year. With government's privatization plans on track, do you see prospects being brighter moving forward and into 2010 as well, where they could easily get involved in these new IPOs coming to the fore?
I mean, I think certainly there's going to be, I think I've said this on your show before, I'm not a big fan of Equity Bank going into, investment banking and that kind of business. That's not really their core business. They've moved into a couple of countries, Rwanda, Uganda, and they look at other expansions. So I think they must stick to their core business, which is lending to the unbanked and mopping up deposits in that market. So I'd be much more comfortable for them to keep on that growth strategy part. But obviously, with agriculture having been a problem and the rainfalls in Kenya for the past couple of years and the political crisis of early 2008, I think it's creating a low base for them. I think they're being prudent and smart to try and take up their provisions now, and obviously it creates a nice base effect for the economy to recover into 2010.
That having been said, Roy, do you see other banks pursuing the strategy of targeting IPOs more aggressively, considering how handsomely it paid off for Equity Bank last year?
I don't see them quite aggressive unless actually the economy really improves, because actually it has been a lesson learned with regard to exposing your loan book to equity prices. So I think banks will be more conservative in that regard going forward.